Over the past 5 years, the cost of everyday goods and services in the US has risen by more than 25% on average. Eggs that in 2020 cost $1 now cost $3 or $4. Gasoline prices have doubled and home prices surged to record highs. This has been one of the steepest 5-year increases in living costs in over 30 years, even higher than before the global financial crisis in the 1990 recession. So it's no surprise that recent surveys show nearly half of Americans now say the cost of living feels worse than ever. And yet, headline inflation tells a very different story. It has fallen sharply since its 2022 peak and is now sitting around 2.7%. That gap matters because the last time we saw an affordability squeeze like this was 1971. Back then, headline inflation had also cooled to around 3%, but prices didn't stop rising. Instead, inflation surged again, eventually reaching nearly 15%, and the economy fell into a deep recession. If today follows the same path, that of course could have devastating economic consequences and impacts on financial markets. But to see whether that's probable, we need to break it down into its components. Because if inflation is about to reaccelerate, it has to come from somewhere. One place people often go to is core goods, especially with tariffs back in focus. And indeed, after contributing almost nothing to inflation for a couple of years, core goods prices have started rising again. That includes everyday items like cars, appliances, and household products. But when you look closer, economists tend to agree on one thing. Tariffs usually create one-time price increases, not the kind of persistent inflation that keeps compounding year after year. And just as importantly, core goods typically make up a relatively small share of overall inflation. The largest inflation component throughout the year, including today, actually comes from shelter, which means if inflation were about to reaccelerate, this is where it would most certainly show up. But when we look at the data, the picture doesn't point in that direction. Yes, home prices surged after 2020, but over the past 3 years, they've largely stalled. A renewed inflation spike would require housing prices to start accelerating again. But with affordability already stretched, mortgage rates still elevated, and housing demand sitting near levels last seen during the depths of the global financial crisis, it's hard to see prices suddenly taking off from here.